Savitha, good to have you on. I've read your note. Why do you think stocks can fall further from here?
Well, hi, Seema. It's great to be on. So I think, one of the things that we're looking for is a real sign of capitulation from a sentiment basis. And while everybody says, the world is incredibly bearish, it's time to get bullish, when the world is actually incredibly bearish, nobody is saying the world is incredibly bearish, it's time to get bullish. Everybody is under their desk. We did some work looking at kind of what it takes to get to a market bottom in the prior, 10 bear markets that we've seen for the S&P 500 going back over, 50 or 60 years. And I think what's interesting is that a few things seem like they really need to happen in order to get more constructive on the overall index. First, what we've seen historically is that before the market bottoms, the Fed typically cuts interest rates. Now, that seems like it's a ways away. In fact, our economists are forecasting that happens maybe, third quarter of next year. So that makes me worry. But I do think it might be different this time. Obviously, what's happened in terms of Fed easing has been unprecedented. So maybe it doesn't work the same way in this bear market. I think the other factor that we need to see resolve itself is just earnings. And when you look at what analysts are forecasting for next year, they're forecasting above trend earnings growth. They're forecasting peak margins. This is in an environment where companies are in the process of, shifting supply chains, spending CapEx, lots of inflation. Companies are losing pricing power. So, Seema, I just see this as a market where at 3,600, you start to look for really interesting opportunities. We're basically there. I think, there are things to buy, but there are still a lot of areas to avoid. 3,600,
that's when you would be a buyer. What exactly, where would you be pointing investors to? As Bob Pisani was pointing out, utilities and consumer discretionary, the two sectors higher from the June 16th low.
Yeah, neither of those we're big fans of. Utilities is basically a bond, so if long rates rise, I think that's a sector that typically gets sold. It's also a sector that's laden with debt, and I think that's a risk in an environment where yields have monstrously increased. I think, consumer discretionary, we're underweight, and I think that's a sector where you really need to look hard at what the expectations are for these stocks versus what's actually happening. And labor has been sticky and high in terms of inflation. Consumer discretionary, these are some of the most labor-intensive stocks in the S&P 500, and they tend to get hurt by labor inflation. And what we're seeing is that while pricing power is starting to decline for some of these companies, labor is still remaining relatively high. So I think that's what we would watch in order to get more constructive. It's a meaningful drop in wage pressure. I think, where we see the opportunities, I would just keep repeating to myself, cash is king. You mentioned this a second ago, yields are close to 4%. That is a very competitive return on an asset class. So where do you go within the S&P 500 to get that cash? You look for free cash flow yield. And where we're seeing free cash flow yield is still in energy, it's in healthcare, it's in parts of industrials, but I still think there are a lot of opportunities to load up on high free cash flow. I would just screen the market on free cash flow to enterprise value and look for the stuff that's at the top of that list.
Shepard Smith here. Thanks for watching CNBC on YouTube.